how is the Federal Reserve going to raise the short-term end of the yield curve without creating a flat yield or an inverted yield curve? I mean, how is this going to work out?
Well, they might actually do what you're thinking that they might not do. I don't know that for sure, but Jay Powell is a quite different Fed chairman than Yellen and Ben Bernanke. He's data-driven, not market-sensitive, so much to speak. But the Fed is doing a couple things. Obviously, they're raising rates and trying to get to what you call normalized rates, but they're also unwinding their balance sheet, which is selling treasuries and mortgage-backed securities. To put it into perspective, in 2008, they bought these assets and used them as money to inject capital in the markets, and they did this at zero interest rate policy called ZIRP. And so they really artificially moving the market on injection of capital. That has come to a halt. They're pulling away the punch bowl, and now the market's kind of trying to stand on its own 2 feet. And by the way, the Fed in 2013 did series of modeling on computerized data to see what the effects would be by them raising rates and pulling away the punch bowl. In other words, taking away and unwinding the balance sheet. And every model they came up with, David, said this is going to cause market turmoil. So if you look at that, when we went in January of this year, when they sold the treasuries, which happens on the 15th and at the end of the month, on February 1st, we had huge 1,100-point drop in the market. It wasn't because of tariffs at that point, because those really weren't even being put into effect till March. So the pulling away of the punch bowl is a graduated thing, and the Fed by the end of fourth quarter will be at $50 billion a month of retracting treasuries and mortgage-backed securities. While this has happened, though, the European Monetary Union, the Bank of Japan, has been injecting money, about $150 billion into the market.
They're still easing, so they're not helping us out very much, are they?
No, not at all. But their program, they're starting to shrink down. When we get to the fourth quarter, they'll have stopped their injection of capital. And 2019 December, they're going to start raising rates. So they're going to follow. They're about 2 years behind what the Fed is, in essence. So when this happens, we're going to have a negative influx of money globally. That's not going to be good on global markets. That's why a lot of people are calling for a recession in 2019, maybe in 2020.